So that sort of Neil Woodford are the kind of long-only fund managers who are not that good. And the hedge fund managers are the elite, if I say so myself. Okay, to give you an example, Jeff Bezos was a hedge fund manager at D.E. Shaw and then became the world's richest man. All right, so that gives you some kind of an idea. Where else am I getting my information from? Well, 20-odd years in the markets, okay? Published lots of books like this, Investing Unplugged by Palgrave Macmillan. Lots of great reviews from wonderful people. Enough of that. Let's get on with it, Alpesh. We've got a lot of slides to cover. Okay. First of all, I'm going to tell you guys to leave. I want people to leave who are here to gamble. All right. If you're here to say, Alpesh, I want to double my money by tomorrow morning, please leave. This is the wrong place. You're in the wrong place. If you're here to gamble, if you're here to think you can sort of just throw the dice, find something, and hopefully it'll make lots of money by tomorrow morning. Ain't going to happen. We're here for a professional approach. We're here for a serious approach. We're here because there's a whole bunch of you who are retired, are pensioners. There's a whole bunch of you who on the other extreme have got £1,000 to invest. So it's all your money in the world. All investing is risky, of course, but it is all your money in the world. It's money for the future. It's for serious purposes. Okay. If it's here just to toy around and play, then Ladbrokes is where you want to go. All right. So I don't mean to be harsh, but this is a serious business and it's my profession as well. So I like people to take it seriously. Okay, great in terms of the FTSE. And obviously many of you are bullish. I'm glad to see and hear that. I suspect you're right. But we'll see to what extent. Let's see if you're more bullish or less on the Dow. Okay, next chart. Well, in terms of being right, this is the last month. Bang up to date. This is the last month, my friends. The Dow's up 13% in a month. The NASDAQ, the US technology rich index, is up 18%. Okay. And the UK markets up 9%. They tend to lag over any rolling annual period, 3-year period, or whatever. The very first article I wrote in the Financial Times in 1999 started off with the sentence, I'm selling all my UK holdings and buying only American ones because the American markets tend to rise. Now, you might think that's unpatriotic. It isn't. As a Brit, I've got Americans working for me in Apple and all sorts of other companies I'm going to tell you about, and they're paying me rent. Because as a shareholder, I'm the landlord, they're paying me rent. I'm bringing that rent back to the UK, spending it here. So, it is patriotic nevertheless. It's nice to have Americans working hard for me. Now, Dow, NASDAQ there. So what the heck's going on? We've got fear of missing out. Have we missed it? Have we missed the big rises? Are they going to continue? If they're going to continue, in what? Where's the opportunities? Right? That's what I'm going to answer. April, global equities. This is according to Bloomberg, which is the #1 source for financial information in the world. Global equities are poised for their biggest monthly gain since 2009. In fact, they achieved it in April. All right. So what's happened? Have we missed it? What do we do? All right. Okay. Morgan Stanley sees world economy is bottoming out. That's their view. Let me tell you something else. Let me give you another view. See that at the bottom? That's something I had written. Oh, my face is in the way. Let me get rid of my big, fat, ugly face. There you go. US in war or crisis begets a bull market. The Dow Jones has risen almost without fail within 12 months of every single major US crisis. That's actually something I had written in the Financial Times after 9/11, and it still holds true. It held true after 9/11. It holds true now. All right. It's the job of people like me to know this and to share this. Okay. And that's the point of what I'm doing now. Okay. So 1 month performance. This is the 1 month global performance. Every single stock you see here, and I'll mention some of them a little bit later. I'm just giving you an overview at the moment. Every single stock you see listed here is a global company which is listed in the United States. Okay. So Alibaba, which is Baba, over here, just make sure, yeah, you can see it. That's America's Amazon. It's China's Amazon. It's listed on the New York Stock Exchange through what's called an American depository receipt, so I can buy it just like I can buy Microsoft. So which of these should we own? Because we want some global exposure. We don't just want to have UK exposure. If you're British, if you happen to be in the UK, I know some of you from Sweden, Denmark, and all the rest of it, because you're already exposed to your own country. And I've already said some of the big global companies tend to perform there. So which of these look attractive? After all, we've got companies which in the last month alone, in the case of Shopify, which is that one, that Shopify, as people are buying things at home, that's up nearly 100%. That's doubled in a month alone. Okay, let alone some others. So how do we measure which ones are risky, which ones aren't? How long do we hold them for? What's worth holding, what isn't? How do we evaluate all of that? But one thing's for sure, we need to open up our universe beyond just buying name recognition in our domestic markets, because that doesn't give us enough return. It doesn't give us enough choice for success. And by the way, just looking at the American markets alone, this is the last this is the last month in just the American markets. Clive, you're right, it's very green. Green represents how much they've risen. The lighter the green, the more they've risen. Reds mean they've gone down. Microsoft up 17%. Now, those of you who even before the lockdown were at my talk in the Novotel in Hammersmith will know I own Microsoft and Apple, and I tell you how I own them. I don't just get $1 when they go up $1. I get $2. All right, and I'll explain to you how. And it's not a spread bet or CFDs. We're not here for trading. We're here for investing. So in the case of Apple, I'm up 50% in a month. Now you might say to me, "Whoa, Alpesh, you genius." Well, not really. And Amazon's up 40% in my portfolio, and you'll know if you follow me on Telegram that that's the case, and Google and Facebook. Okay, Netflix I don't own, my son does, my sister owns Disney. If you've been following these, so how did I come to it? It's not genius. It's not genius at all. In fact, it's plain as your nose. Now you might say, well, hey, hang on, why didn't you just triple mortgage your house and borrow from every credit card you get your hands on and just dump into just Apple, and you would have made 50% in a month? Well, because there's something called risk as well. I didn't know when I was going to get the return. I didn't know I was going to get it this soon, and I'd get it. I didn't know it was going to come this soon. I don't try and predict too many things. I might predict Apple's going to go up, but I don't want to try and predict in this month. That's gambling. Okay, too many predictions, too much like gambling. So how did we pick these? How did I pick some of these? Oh, by the way, don't get me wrong. I missed more moves, big moves than I got, but that's fine. Hey, I don't care about what I've missed. I don't look back and think, oh, I missed it. I'm not trying to run around trying to grab like a kid in a candy store, trying to pick every single thing I can, because there's a limited amount of money. Okay, if you divide your portfolio into 15 equal lots, and I'll explain why 15 equal lots, you can't say, oh, I'll buy that, I'll buy that, I'll buy this, and I'll explain why in a second. So how do we pick out of these? We certainly want to have some of those returns you see on screen, and that just happened in the past month. So how do we decide them? Okay, and the answer, by the way, isn't just, oh, Alpesh will throw some fish on his Telegram channel. That isn't the answer. The answer is, well, actually, how's Alpesh going to teach us how to fish? How's he going to teach us how to find these? By the way, if you want to know why some of those have been rising, contrary to what you might here when you're watching the news, is this. These are the real GDP projections, annual growth of the world next year. All right, China almost 10%. That's as high as it's ever been. UK 4%. I don't think we've had that since the 1950s. United States 4.7%. We've not had that since the Second World War, I don't think, in terms of growth. Now, I'm not saying, hey, isn't everything wonderful? Let's not forget, look out of your window, there's people dying. Right. So as when I used to do my Bloomberg show before we went on air before crisis, we'd remember that even without viruses, when markets are falling, when people's futures are uncertain, that's a sad time. That's a sad time. Let's not forget that. So I don't want to sound over optimistic. Isn't everything wonderful? Because we do remember we live in the real economy as well. But this is why those stocks are moving. That's all I'm saying. Okay. It's not a moral judgment. And we better look at non-UK stocks, or not just UK stocks, because European stocks on one measure of valuation called the price to book ratio. The price to book ratio is basically measures if you liquidated a company, and God knows some of them are going to get liquidated. If you liquidated a company, how's it trading at the moment, its share price, in terms of what you'd get if you did a fire sale. So if the price is below 1, it suggests it is trading very cheaply. It suggests that the price is half of what you'd get if you did a fire sale. So you'll be able to buy a company at half of what it's worth, is what this ratio from Bloomberg. And by the way, whenever I source Bloomberg, that means it is the most reliable financial source in the world. It is better than any other. It's as simple as that. Not just because I presented my TV show on there, but because it's just fact. All right, it's fact. It's the one. Now, I've got some of you asking questions like Rakesh about specific things. I'll come to those in the end in the Q&A, like crude oil and gold, and I'll probably end up answering some of those. But does that mean we're just going to go up and up and up and up? Because in actual fact, this piece of data suggests of the 26 bear markets since 1929, so in the last 100 years, there have been 26 bear markets where the market's fallen 20%. Well, you can see how often, just got to make sure, because I've changed my screens around. Yes, you can see it there. You can see how often it made a new low. Now, we haven't made a new low. In other words, we haven't tested the low of a few weeks ago. How often does it happen? What's that? 50% of the time or 60% of the time? So more often than, guess what's interesting, guys? If you followed me on Telegram, you would have heard Alpesh Patel say, I think there's a 60% probability we're going to go lower and a 40% probability we've seen the bottom of the markets. Isn't that interesting? Statistics are on my side. I should tell you, when I said that 60-40 rule, it wasn't based on having seen this. I only saw this now and, well, this morning, and then realized, oh, well, haven't I got a good intuitive sense? Do you notice what I said there? I didn't say, oh, we're going to go lower. That's gambling. Are we going to go lower? I'm not here to predict the future. What I am here to say is whether we're going higher or lower, my bets are covered. In other words, I'm going to make money whether it goes higher or lower. So I think there's 60% probability we'll go lower, 40% we've seen the low of the market. Whether it goes higher or lower, I want to be making money. And so should you. That's the kind of strategy you should have. So how the hell does that happen? This is one of those you might want to take a photo of. I will try and make this available through the internet, through various sources. But in case I don't, you might want to oh, John, just email me, please. It'll be easier if you email me, please. Now, the markets are either going to go up, in which case, I think there's a 40% chance they just continue going up and up. That's that blue arrow, okay. Or they're going to fall. Oh, I've got rid of my beautiful face. There we go, chubby face. Right. Now, if they go up, you've got three things that are going to happen. You're going to have quality stocks. If the markets go up, well, I'll continue buying those quality stocks like the Amazons, and I'll explain how I decide what's quality and what isn't. And this applies to all of you. You've only got two decisions to make: buy, sell, or hold. Well, three decisions: buy, sell, or hold. Okay, three decisions: buy, sell, or hold. If the markets go up, your quality stock, you buy more because you're going to hold them forever anyway. Okay. Or you've got performance stocks. You've only got two types of stocks you ever own for the long term: quality or performance. And I'll explain what each of those categories is. You see, notice how I'm simplifying your thought processes bit by bit by bit. I'm simplifying everything. Okay, performance stocks, you will, if the market goes up, hold, or you will buy according to your strategies. Okay, if the strategy says buy more, you'll do it, but you've got to be really careful. I don't normally buy more of a performance stock, but if my strategies, and I've got 7, and I'll explain those in a second, what they are, okay, I'll buy more. If you've got low quality stocks, which you shouldn't own to begin with, well, you got lucky the market rose. Don't ask my advice on low quality stocks, okay? Most private investors end up owning these, right? Okay, now let's say then a bit of time passes, maybe 12 months. What happens? Well, what will have happened is your quality stocks, well, you're going to hold those forever, so you just buy more of those. Performance stocks will either have hit your target price or your target time, and your target time is usually 12 months. A lot of people are saying connections drop. Let me know if you can still hear me loud and clear. Let me know. It's just that we've got hundreds of people on here, and that's actually the reason why the connections drop. What I'll do is I'll get rid of my face, and hopefully that will help the bandwidth. Okay, if you can hear me, let me know. All right, can you hear me? Yes, you can. So I'm going to continue. It just means that some of you have lost it. I apologize. Okay, so quality stocks, you'd just buy more, wouldn't you? Or you hold forever. Feel free to take a picture of this and print it out. Okay, performance stocks will either have hit your target, in which case you'll sell, or you said you'd hold it for 12 months, in which case you'd sell. If they're still in one of the 7 strategies, okay, then you'd hold them. Simple. Do you see this decision tree? If they're low quality, you shouldn't have owned them anyway. You got lucky. The market rose. Don't ask me. It's up to you. You know, a lot of people have low quality stock thinking, oh, Pesh, I've got this low quality stock. What should I do? And I say, well, stop talking to me for a start. You know, don't ask me. Well, you know, dug a hole for yourself. So don't ask me about low quality stocks. Now, alternatively, what's going to happen? Okay, erase all link. Alternatively, what's going to happen is the market will have fallen. Right? Well, what happens then? Well, if it's a quality stock, we do what Warren Buffett says when asked, if the market falls at 20% in Apple, what would you do? And he said, I'd buy some more. Okay, it's as simple as that. Reconnect if sound gone. All right, simple as that, right? So quality, you'd buy some more. If it's a performance stock, you'd hold because it's still within your strategy, but you'd never buy more. You'd never buy more of a performance stock if the market's fallen. Low quality, well, you shouldn't have owned it anyway. What were you thinking? Now, let's say a bit of time passes. The quality stocks, you buy more because you're holding them forever anyway. So a bit of time's passed. They're still, you know, below where you bought them. Fine. The performance stock, still below where you bought it, bit of time's passed, well, you'd sell because your time target, maybe 12 months, has been hit, or you'd hold it because it's still in one of the 7 strategies. Simple. If it's low quality, well, you shouldn't have owned it anyway. Stop coming crying to me. That is your perfect decision tree. But we need to fill in some information in there like, Alpesh, what's a quality stock? What's a performance stock? How do I know when the time limit's hit? So let's do that. Okay, by the way, bit about me. We don't take retail clients, so I'm not here to plug our funds. We have several funds in private equity and hedge funds for institutions only. If you happen to be a sovereign wealth fund, if you're calling from, if you're, I don't know, mention a sovereign health fund, Qatar Investment Authority, Temasek of Singapore, the Norwegian Sovereign Wealth Fund, please get in touch. Or if you're a pension fund, get in touch. If you're a private individual, sorry, private individuals cannot invest in our assets. So I've got no conflict of interest in speaking to you today. I have no conflict of interest when I wrote my books. Okay, I have no conflicts of interest when, okay, there should be no video on. Let me start again. There was no conflict of interest when I was writing my FT columns. All right, so I'm here to just tell you what I own. That our interests are aligned, because I'm going to put my neck on the block and tell you what I own. Okay, and I'm also going to tell you based on all this experience and expertise and networks and contacts. Now, when I say I put my neck on the block, what I'm talking about is the same stuff I give when I'm on the BBC and talking about the markets. Okay, I put my neck on the block. And I'm doing the same with you guys now. So I'm telling you exactly, and this goes out to 300 million people, so it really is a reputational thing. I'm going to give you the same information I give and the same quality I give when I'm out there as well. Okay, it is the internet, it is bandwidth, it is low. I apologize that it is that bad. Okay, so I'm going to give you all of that information in this, and the stuff that I'm going to tell you, it's been vetted by the Financial Times because it's been published in the Financial Times as well. And when things have been vetted, that's me, look at that, okay, in my diaries in the FT, when they've been vetted by the shrewdest, sharpest people who read the Financial Times, then you know that it's got a lot of vetting behind it. So let's start off with a question, people. Assume you plan to invest over 10 years. I've shown this before in my previous webinars on this, but it's really important you understand this. Okay, imagine you plan to invest over 10 years. And with my help, let's say we reach an annual return of 20% per annum. Okay, some years you'll make more, some years you'll make less. Nothing extravagant, nothing pessimistic. 20% is neither extravagant nor pessimistic, okay? It's neither of those. If you wish, you can tone it down. Now, let's say you got a whopping $100,000 or pounds. Later on, okay, we will come back later on. We'll come back with smaller figures if screen. Now, I'm just letting everybody know there's so many people trying to get on. Or sound gone. Trust me, it'll be worth staying on. Okay, relog in now. Now, let's say you plan to add $1,500 a month. Now, I know for most people, $1,500 is all the risk capital they've got. Don't worry about it. This is the higher end we're talking about. Then we'll come down to people who've only got, say, 10K or 1,000 to invest in. Okay, so we'll come back to that. Now, you will over 10 years, based on these statistics, have $1 million. That's what will happen. Over 10 years, you'll have $1 million. Don't believe me? Those are the figures. Whether it's dollars or pounds, depending on which currency you're in, translate it into, you just use pounds instead of dollars, right? This is what will happen. Over 10 years, based on what I've just told you, you'd get to $1 million. And you know what the critical factor in that is? It's that number. It's that number. That's why it's important I teach you what I'm about to teach you so you can get to this number, so we can get from 100 to $1 million. Now you might say, Alpesh, that's big money. Don't tell me about that. Let's get more sensible. Let's assume you only have 10K to start with. And by the way, don't forget, God willing, in a couple of years, you'll have even more coming in. But let's say you only got 10K to start with and you plan to add 6K a year, which is just $500 a month. Sounds fairly reasonable, okay? This is what your return would look like on the same factors with my help. Over 15 years, let's just expand the time frame because you had less money to start with, maybe because you're younger, okay? You get to about $600,000. So you start from 10,000 and you get to 600,000. That's simply, by the way, that is simply based on the average 20% per annum. Now, some years you make more, some years you make less. You might say 20% too rich for my blood, Alpesh. Let's tone it down a bit. Fine, we'll tone it down a bit. That's how you get to that figure. All right. That's with my help. Or maybe you don't need my help. Maybe after this webinar, you never need it again. That's fine. Okay. 20%. That's what we're looking for. That's the figure. That's the figure. Sorry, a lot of people are having sound problems on this. Hopefully the sound will resume shortly. Okay. It does, when you've just logged in, take a while for the sound to catch up and the internet and everything else to catch up. All right. It takes about 10 minutes or so after you've logged in. All right. So that's what will happen. I'll answer the questions, Michael, as we go on. So agenda for this webinar: part 1, problems. What are the problems in investing now? Part 2, the solutions. The stocks I like, Goldman Sachs like, Warren Buffett loves. How do we get 100 to 500% returns over what timeframes? And then the Q&A. So let's get on with it. Problems. People are currently picking stocks like they're hoarding. They're a hoarding panic buyer. Most people I speak to email me, they go, "Oh, but you got this. I don't know when I picked these up. I don't know how I ended up with them." They're like this. This is how most people pick their stocks, right? They don't need them. They don't know what, they got no strategy, and it's crazy. Okay, it's absolutely crazy how they're doing it. This is what's happening. That's how they're doing it. Or alternatively, they find some names. These are the most popular stocks from one brokerage that they found that people were investing in. A whole bunch of these are the most popular. So they hear some names. They hear Aston Martin somewhere in the news. They hear Tullow Oil or whatever, Redrow, and they think, "Oh, I'll just buy these." Okay. By the way, the ones I've circled here on the US markets, I'm confusing things now. Let me just remove this. The ones circled in red are the ones I actually happen to own. Beyond Meat has got nothing to do with my analysis. It's just to do with my heart. I'm a vegetarian. That's why it's got nothing to do with where I think it'll be. If I've lost all my money in Beyond Meat, I don't care. It's with heart, not head. All the others are with head, not heart, and I explain why. So my point is this: most people, they just hear some names. It's a hot pot. That's a problem. We need to be more strategic and systematic, because we're talking about earning $1 million here. We're talking about becoming millionaires here over a period of time. Secondly, people don't know when to let go. So they've got all this crap they've picked up from just random methodologies, all right? And then they don't know when the hell to let go. Okay, so they marry their stocks. They don't know when to go. To the extent they'll just keep holding them until they're extinct. This is a serious problem. So we need to give you an idea of when do you sell. How do you have a proper process, systemized process? The next thing people have, the problem they get into this, is because they're trying to pick a winner. You know what this is? This is the annual returns, okay, since the last 20 years of the Dow's largest companies and which ones perform the best. So the ones with the highest annual returns are at the top. The highest annual returns are at the top. They're trying to pick the one winner. That's what people are trying to do. That's the problem. I'm not trying to pick a winner. My job is not to try and gamble which company in 2020 is going to be the best performer. If you want to do that, go get a dartboard. My job is to pick the best collection of 15 companies that outperforms not just the index, but every single UK company fund manager. And I've been doing that. Got it? I've been doing that. So that's my point with this, that we're not here. And this is what people don't realize. They think they're here to try and pick the best. No, they're here to pick the best team or the best portfolio. You want to pick Manchester United. Well, it used to be Manchester. You want to pick Liverpool as a team, not the best forward, not the best whatever. Okay, because otherwise you're gambling. So how do we do that? I'm going to solve that problem for you. Another problem I'm going to solve for you is rubbish fund managers. Don't give your money to fund managers. They're overpaid. They're rubbish. Remember, long-only fund managers. Hedge fund managers are better, but you're not allowed to invest with hedge fund managers against the law. Right? Fund managers, right? You're going to be, in this webinar, your own fund manager. Why and how are you going to be your own fund manager? Well, I was. That's me on the front cover of the business section of the Financial Times. Patel's FTSE 100 top forecaster. I beat Neil Woodford amongst others, actually every other major fund manager in the country as well, and ever since. And in 2017, he had to apologize for how rubbish he was. Well, in 2004, we knew he was rubbish because he barely beat Jasper the bloody cat. Okay, this guy... and this is my point with long-only fund managers. I used to lend these guys money when we were at university together. They're that rubbish at managing money. Honestly, they can't get a job elsewhere. They're and that's why they become long-only fund managers. Okay, my secretary is now a fund manager. After I trained her up, she's a fund manager managing $10 billion. Right, I'm telling you, I can make anybody a fund manager. She's actually quite good because I trained her. She's at Newton Asset Management. Okay, Naomi Wastel. She used to be my secretary. Simple as that. Now, my point to you is not that I'm bragging. I'm saying anybody can be a fund manager, and I can make you a fund manager, and I've done it. Okay. The problem with fund managers, long-only fund managers, is this. 99.4% have no genuine stock picking ability. They're just lucky. And if you want to know where the source of that information is, it's the New York Times, and it's data from there and ample research which has been done. And by the way, the people who did that research, subsequent to that research being done, won the Nobel Prize in economics. Problem number 2, we're going to solve this in this: rubbish private investors. I'm afraid the average private investor, just in case you're thinking I don't need fund manager, I'll do it myself. Well, 20 years annualized returns of the average fund manager, 1.9%. I'm afraid you guys are not that good either. Source, Bloomberg. Source, Bloomberg. Okay. Problem, you don't understand risk. And let me explain to you why. This is something I put on my Telegram channel yesterday. The stock is at 100. It rises 10%, then drops 10%. The next week, it rises 10%, drops 10%. The third week, it rises 10%, drops 10%. How much money is that stock now worth? 13% thought it's still at 100. 21%, a fifth of the people thought it's over 100. Okay. 1/3 of the people got this answer wrong. That worries me. It's actually under 100. They don't understand risk. They don't understand risk. This is simple. This was a question I once asked in one of my Financial Times columns, and I was shocked how little private investment is. So my job is to give you some simple understanding of risk so that you can become millionaires. That's our ambition, is everybody become millionaires. And by the way, you're not going to become millionaires by me saying, oh, this is going to be the best performing stock next year. I've already told you that's not what we're in the business to do. Okay. Problem 2, you don't know where to look. You don't know where to look, so you're like this guy. You're like this guy. You're absolutely bloody nuts. Okay, we're looking everywhere. There's so much crap and information. Problem 3, we don't know what to look for. Look at all that data. People don't know what to look for. That's my sister's portfolio that I help her out on. Okay, do we look at consensus? Do we look at target prices? Do we look at what directors are dealing? Do we look at price to free cash flow? What do we look at? Do we look at gearing? We don't know. There's so much data, people don't know what to look for. Like I said, there's only 2 types of investments. Quality, so we're going to pick quality according to our 7 strategies. Okay, buy more when the price falls because it's quality we're going to hold forever, or performance-based, in which case we focus on either it hits our price target or our time deadline, which is usually 12 months, whichever comes first. And then we decide, is it in one of the strategies or not? The private investor areas, they keep buying bloody poor quality with no strategy behind it. And when they get losses, they add to them and they sell their profitable investments to pay for their losing ones. Right? Simple. I've just simplified it. You've only got 3 choices in life: buy, hold, or sell, kiss, snog, or marry. Right? Whether it's in your personal life or your investment life. Okay, we're going to avoid the one that got away by making sure we know where to look, what to look for, and we're not going to marry the bloody wrong one. Right? So we're either going to buy more, or hold if it doesn't hit our target but fits our strategy, or sell if it hits our target and it's no longer in a strategy. That is it. I've just simplified your thinking processes. If I simplify your thinking process, I get you closer to becoming millionaires. Right? Problem 4, there's expensive courses and subscriptions. It's my job to own subscriptions. It's my job to pay $2,000 a month to Bloomberg. Okay, and all the other subscriptions, I probably pay about $4,000 a month in subscriptions. That's my job because I'm a geek. I love this stuff. It's not your job to pay that. It's my job to then take that information, simplify it, and give it to you in things like this free webinar. All right, it's my job to be Robin Hood. I take from these kind of sources and give to you. Problem 5 we're going to solve in this webinar: who to trust. Okay, and by that, what I mean is this. These are some of the biggest banks. They don't even know where the S&P, the US markets, are going to go. We'll talk about UK and European markets in a second, okay? The S&P 500, this is Bank of America Merrill Lynch, think 2020, it'll be at 2,600. Barclays, think 3,000, okay? Citigroup, 2,700. Look at how wild these variations are. Deutsche Bank, 3,250. Goldman Sachs, 3,000. What the hell am I supposed to do? What the hell am I supposed to do? Which one of these do I trust? Okay, Morgan Stanley, 2,700. JP Morgan, 3,400. Basically, there's a whole bunch think it's going to be 300 points higher. There's a whole bunch I think it's going to be 300 points lower. And these are basically the best and brightest in the world. Well, great. One more reason why not to trust them then. Okay, so there's a problem with trust. We don't know who to trust. Well, I'm going to suggest you might want to trust me, not only because I'm the one who Goldman Sachs pays to speak to their audience, because they can't trust their own staff, because they can't hire and afford me as their staff. Merrill Lynch, HSBC, these are all past and present paying clients. They pay my company. They pay me to speak. Okay. They host my book launches. That's the CEO of Barclays. So I have to at least better tell you when I say don't trust anyone, I better at least say you better trust me. All right. So I am, as you know, several of my many books. Don't buy my books. I get £1 in royalties. And I'm trusted by the BBC to speak to 300 million people. I'm trusted by my country. That's me because I have a role with the British government to talk about my business, my financial technologies around the world. Okay, so I'm going to suggest humbly, maybe you want to trust me, right? Problem 6, there's a rich-poor divide. The rich, they know the information, they know where to get it from. That's one of my Financial Times columns. People like me are telling them, and by rich, I mean people who read the bloody Financial Times. On the whole, they are. By the way, I grew up with no silver spoon in my mouth. I was born in Armley in Leeds. Okay, certainly no silver spoon. So I've got a personal reason why to make sure I get information from the wealthy and give it to those who weren't so wealthy, because I was one of those who didn't have money, and neither did my family, and that's why I invested. I borrowed £100 from my aunt when I was 12 years old because I thought, wouldn't it be great to buy some shares and then hopefully those people in those companies will be working for me and my family. That was it. As simple as that. That was my background and upbringing. So that's why I love getting that, breaking that rich poor divide by getting that information, making sure you guys have got it. So when I get stuff like this from Barclays, and this is the rich poor divide, people like me in hedge funds get information like this, which is what they're telling their wealthiest clients. Don't worry about reading this, it's too small. That's not the point. Okay, but this is what they're telling. They're saying the likeliest trends to happen with the greatest impact are over here. Don't worry, you can't read it at the moment. I will explain all of this later on. So I need to be on top of this and then simplify and give it to you. Not only that, this piece of research came out just last week, hedge funds and their best ideas. What this research showed, and it's New York University PhDs, is when hedge funds give their best ideas, those best ideas are very much outperforming anybody else. But what they interestingly found is not just their best ideas, but their ideas generally outperform. So it's my job. I'm going to tell you exactly which ideas in a second in this webinar. I'm also going to tell you what UBS's house view is and what Goldman Sachs's house view is and their European conviction of their best and brightest ideas in this webinar as well. Because what we've seen is there've been stocks which have dropped 50%. If something's dropped 50%, from 100, it's gone down to 50, and it goes back from 50 to where it was, back to 100, we double our money. More interestingly, some things have dropped 90%. They've gone from 100 to 10. If they go from 10 back to 100, then we have a tenfold return on our money. So which are these? How do we find these? That's a problem. The rich-poor divide is the big banks are telling their clients, but you're not getting that information. Hedge funds like me are getting it, so we buy into it. So it becomes a self-fulfilling prophecy anyway, whether or not it should. Okay? Problem 7, which broker? How do you buy? We're going to solve that. Problem 8, you don't have an insider who's a mentor. My job as an insider is to get this information from Goldman Sachs when they're telling their clients we're roaring into a recession. I need to know what they're telling their clients to buy. And let me tell you what they are. Let me tell you right now what they are. Here you go. Best ideas, stocks across hedge funds. As at the end of 2019, hedge funds with more than $1 billion in assets under management, that's what AUM means, and all hedge funds. These are the names. Okay, so I'm just going to give you some of these. So I looked at these today and analyzed them. And I have a friend of mine who's a very good friend, so I've got my neck on the block. He said to me, give me some names. I said, I don't have a problem with holding any of these for the next 12 months. Now, what return are they going to give, though? I said to him, look, I think at least 30%. Up to 70%. So I said, I'm putting these in the medium risk category. I don't want to say low risk to anybody for these, but I'm going to say medium. And I'm saying 30 to 70% return. But some of you might say, no, I want more return, higher risk. That's fine. These I own all of anyway. And if you've been following me, you know I've owned them forever. Okay. Schroders have been telling their clients that these FAMAGs, they're called, okay, FAMAGs are better capitalized to weather the economic storm. Now, look, I'm not a genius by any means, okay? I knew these were better because in 2008, these were the ones who had the most cash. And when I looked at their charts, I knew that anyway, 2-3 years ago, that I should hold on to these. Don't ever think of getting rid of them, no matter, because if there was a crash, and I didn't know there was going to be a crash. Well, I knew there was going to be a crash. I didn't know when, and I didn't know why. I didn't know what would cause it. But obviously, it doesn't take a genius to work out there's going to be a crash, because we know sooner or later there's going to be a crash always. These were going to be the best performance. That's not genius. That's just simple. You know, it's just obvious. Okay, so That's my first set of names I'm going to give you, but we need to put these in a strategy. Which strategy do these fall into, Alpesh? I'll put that in, but I just wanted to let you know you're getting names, okay? You're getting bloody good names. Goldman Sachs. I'm going to give you some of the insider, because you need insider mentors. That's my job, to be your insider mentor. So I'm going to give you some information from their reports here and from what UBS are telling their wealthiest clients. Remember, UBS is a Swiss bank. These guys got access to trillions of dollars, not just what they manage, but what they tell when they tell rich billionaires what they should put their money into. My job, by the way, their chief investment officer went to university with me. We were both at St. Anne's College, Oxford, reading PPE together. All right, that's the whole point. Insiders, you know, it is a closed shop, and my job is to share that with you. And also, you know, this is what they're telling their clients. They're telling them which are the oversold stocks. So they got strategies. I'll share this with you. Which are the resilient ones? Which are the longer term beneficiaries of COVID? And then which areas should we be going for stable quality? They have strategies. Why don't you? So I'll tell you how to simplify things into strategies in this as well. And the insider mentor's job is also to show you things like this and say to you, you know why it's important what's happening to America at the moment? Because America represents COVID hitting Japan and UK all over again, Germany all over again, Italy all over again, France all over again, Brazil. Why? Because this is the GDP of the United States as depicted by these major economies. Yeah, that's why what happens to America affects the world twice over. Okay, this, by the way, is what UBS are telling their wealthiest clients, that they're finding the wealthiest clients are waiting for a new dip. So, like I said, if the markets keep going up, yes, we've got some stocks for that. Which are they? I'll show you. And if it falls, I'll buy some more. Why would I buy some more? Because I'll only buy some more of my quality, not my performance, my quality ones. Problem 9, we don't know when to sell. I already said, when do we sell? If it hits our price target, we reevaluate. Our time target, we reevaluate on our strategy. So let's now talk strategies, because those are the problems I've given you. I've given you a lot of problems, my friends. I've given you a hell of a lot of problems. Let me give you some solutions, if I may. So what are the solutions? These are the solutions to all your investing problems and how we get to become millionaires together. All right, based on the savings and the 20% per annum targets I mentioned. Investing strategy number 1. I've got 7 I want to show you. I've only ever shown you 6 before. I've added a 7th one just because people asked for it. Investing strategy number 1. What are the guru buys? Well, I've already shown you some of the guru buys. These are the guru buys. The research shows hedge funds outperform. They're the best of the best. Don't go for what long-only fund managers saying they're the dimwits of the world. They're the ones we kick sand in the face of. They're the ones we laugh at as not being intellectually capable to work for us, because if they could, they'd be working for us, but they can't. We won't hire them. These are the stocks in the hedge fund industry. I don't have a problem with holding any of these for 12 months. I will let you know in my Telegram channel which ones I'm going to, because I only looked at these today and gave them to a friend of mine on, actually, no, I gave them to you guys on Telegram earlier and a friend of mine on WhatsApp. So Dinshaw has these. He's got ahead of it. I'm going to buy into some of these. I'll decide which ones later tonight. Okay. I think 30 to 70% returns over 1 to 2 years with medium risk with any of these. All right. Simple as that. And I've already told you about the FAMAGs. The FAMAGs, like Amazon, year-to-date returns, okay, 28% on Amazon. Now you might think, oh, Alpesh, seriously, Amazon, so simple. I don't own Amazon. Well, I own Amazon. I also own Amazon times 2, double leveraged. I'll show you how I own Apple double leveraged. That in the month has gone up 50%. Guess what? I added to that when it fell. As it fell, I added to it. As it fell, I added to it. Guru buys is what we're talking about. So I need to look at Warren Buffett's portfolio and see what he's buying, what he's adding to. That just gives me a series of names, though. I need to do more research. But if he's added to them, then I know my stock is in strategy number 1. I want it to be in as many of my 7 strategies as possible. Strategy number 1, guru buys. Okay, this is the S&P 500, the US largest 500 stocks. By the way, if you're British, you can buy all of these stocks through your UK broker, whether it's Barclays Stockbrokers, AJ Bell, Hargreaves Lansdown. I don't care which, as long as they're a safe broker. We'll talk brokers in the Q&A. This, the darker the green, the more those gurus own of them. Amazon, United Healthcare as well, Berkshire Hathaway, CVS, Wells Fargo, etc., etc. So that's my guru picks. They would fall into my guru strategy. My job, therefore, is to work out which stocks and names fall into which strategy. I checklist which strategy they fall into, what's the timeline according to that strategy, and then I've got to decide buy, hold, or sell and monitor. So does the strategy have a stop loss in it? Or, for instance, for my quality strategy, quality stocks like Amazon, I don't have a stop loss because I'll just buy more if they fall. So that doesn't have a stop loss. Others do have stop losses. So we'll look at each of those strategies and which one it is. Time to review. Example, if the strategy is specified a 12-month target, then I've got to review it in 12 months. Do I buy more at that point? Or do I see if it falls into a new strategy? Or do I sell? Simple as that. Buy, sell, or hold based on this. That's all I need to know. That's all I need to know. So let's look at strategy number 2 then. Strategy number 1 is a guru's behind it, but I need it to be more than just that. Just because the guru's behind it doesn't tell me enough. So strategy number 2, I leverage big on low risk. I find the low risk ones and I leverage big. What does that mean? Well, this is the S&P 500. I have got an index tracker which is triple leveraged S&P. What does that mean? That means every dollar the S&P, the US markets go up, I make $3. Why did I buy that? I bought it forever for my great-grandchildren to have because the American markets tend to rise more often than not. In 14 years, in the last 100 years, there are 14 years where it's risen between 0 to 10%. There are 20 years in the last 100, so 1 in 5, where it's risen 10 to 20%. And there are 35 years, i.e. 1 in 3 years, where it's gone over 20%. In other words, more than half the time, the S&P has a positive return. So I want triple leverage on that. Every time it goes up $1, I want 3. I don't want a spread bet or a CFD. I have a triple leverage ETF or exchange traded fund, an index tracker. What is that? And I've written about it in my Financial Times columns, and you can see some of my holdings in my pension here. Bang, that's in my pension. These are to be held. I'll tell you which one's forever. My Amazon is to be held forever. That's already up 75% in the last, whatever it was, couple of months. This is not forever. This is a performance stock, Inovio. Apple is forever. Premier Oil is not forever. It is a performance stock with a 12-month target, which I'm willing to hold for 3 years if I need be. That's already up 33%. Okay. The S&P 500 is here. 3 times leverage. That is to be held forever. I'm already up 30% in that. The leverage shares on Amazon are to be held forever. I'm up 26% in that. Can you see how my 20% per annum isn't too ambitious now? Crystal is performance, not to be held forever. And Microsoft is to be held forever. I'm up only 10% in that in the past, whatever it was, month or 3 weeks or whatever. Okay, so that's investment strategy number 2. What was investment strategy? Leverage big on low risk. What is low risk? I've just told you which one was low risk on there. Investment strategy number 3, X-ray quality. Again, these are quality means low risk. What is quality? Well, there's an index tracker in the US called Quality. It's literally called Quality, and it's been rising. It's an index tracker, and I think it's going to resume backwards. So you might buy the index tracker, but some of you might say, I don't want a whole basket of quality stocks. What's in the stock? Open the basket, Alpesh. Show me what's in it. Well, that quality exchange traded fund is made of these, and you might say, oh, I like these. These are all quality companies. In other words, you're fine holding these forever. Okay, they're quality. Now I've got Microsoft, I've got Apple, I've got Visa, I have got Merck. Okay, just so you know, I have no problems holding some of the other. Oh, I've got Facebook and I've got MasterCard. All right, and you might say, you crazy? MasterCard? Oh, let me give you a whole story about how people aren't buying transactions. No, I've analyzed it on other criteria. On this strategy is not to do with people buying or selling. It's to do with, is it quality? Quality is based upon not just being in this index tracker, but quality is based upon the size of the company, the cash reserves, the working capital, and how essential it is to the future of the world, and how much of a market share it has, etc., etc., etc. Now you might say, that's not enough, Alpesh. I want to know, of the quality ones, which ones are really zipping ahead within that exchange trade fund. So here are some names for you. I have no problems holding these either for the long term. Okay. The reason I don't have a spread bet is because the interest rate charges overnight in the spread bet, which is geared towards trading, are too high. Remember, I'm not looking to hold these forever. I can't afford to hold a spread bet for 100 years. I can't afford to hold a stock or a double leveraged exchange traded fund for 100 years. If you want to know what quality looks like, if you're looking at a lot of data, this is what it looks like. Now, I don't expect you to understand all of this, but what I'm saying is, if you're looking at quality, this is what, and this is Microsoft, would look like. It means lots of free cash flow, okay? It means free cash flow growth. That just means it's generating a lot of cash. It looks like there's a target price above its current price, but that's less important. What you need to be able to know, and I'll teach you in this webinar, which pieces of this information are important, and how important are they? What and how? Because not everything's important. That's why journalists mess it up and confuse you. That's why other people are trying to get you to buy into funds, because they're trying to make you think, oh, it's too complicated for you to do. No, I'll simplify it. There are only ever 3 or 4 pieces of information which are important. All your job in anything in life is to work out what's important and how important is it. What is important? How important is it? The mistake you would make is looking at every piece of information and thinking it's all equally important. Obviously, it's not. All information is not equally important. Only a little bit of information is important. Your job and the job of judgment is working out how important. I'll tell you which is important and how to weigh it in 1 second. Okay, and that brings me on to strategy 4A. What are the banks telling their richest clients? Well, previously, I would not look at what banks are telling their clients because, as you can see in 2019, and I've written about this in the Financial Times, what banks are telling their clients is this red line here. That's the price target they're giving. This happens to be Petrobras, which is Brazil's oil company. You might think, what the hell? Am I going to get my hands on that? Well, it's listed in the New York Stock Exchange. You buy it the same way you buy Microsoft. Same thing. Okay. All right. John, many different sources of data I'm getting, some from Bloomberg Terminal, some from subscription. I'm sharing all the data with you for free, okay, on this webinar. Now, that's why I don't like analysts, because they're always out by about, what, 20% over-optimistic, except if they're 20% over-optimistic now, I get to double my money. Not if it hits their price target. Forget that. Let's say they're optimistic and it only gets to 10 from 5. I've just doubled my money. Petrobras, I don't mind owning. Now, but for what time frame, Alpesh? Is it quality or performance? No, it's performance, because I think it's going to go back. And this is what I know the banks are telling their richest clients. How do I know this is what the banks are telling their richest clients to buy? Because that's the analyst price target. That is the average consensus of what the biggest banks are telling their clients to buy. Now, how do I mitigate risk? Obviously, it's not going to get there tomorrow. So if you say, Alpesh, I bought a load of Petrobras, it's been a week and it's not gone up. You get, Alpesh, I've lost money in a week. No, I'm saying I give a timeline of 12 months. Either it'll have hit my target or it'll still be within my strategy of analyst or one of the other strategies. If it's not in any of those, I'll have sold it in 12 months anyway. Got it? Citigroup, same story. I will get to have a 50% increase in Citigroup. It's not going to go bust because this is what the analysts are telling their clients. How do I know this is what the analysts are telling their clients? That's my job to know and for me to give you. Okay. Comtech Telecom, have no issues with them. Okay. Slightly higher risk, but I make what? Not 100% return. If it is the analyst target, I make 100% return. Simple as that. Okay. Capri Holdings, I make 134%. No, let's say the analyst is over optimistic. I'll make 100% return instead on that. So I own some Capri. I own some Walt Disney, not to double my money. 44% to the upside. Let's say I only make 30%. This is the one I told my sister to buy because she needed some money for my nephews and nieces' school fees in 10 years. So I had to get it right because my sister will kill me if I get it wrong. Secondly, it's my nephews and nieces' school fees which are at stake. That's all I'm telling you. That's all I'm telling you. Okay, 12-month target, quality stock. It's also what the banks are telling their clients. So it hits strategy 1 and strategy 4A. Uber, a little bit more risk, but I'm okay with it. 55% to the upside. Let's say 40% instead. Slightly lower risk. You might say that's not enough risk for me. Okay, Hertz, high risk, but a big company. You know, there's bankruptcy talks. You might say too much risk, Alpesh. Whoa, I'm fine with it. I don't know whether you'd be, but I'm fine with it. Don't try and be me. Don't try and be me. I'll pick things which are not suitable for you. Don't try and copy me. Don't copy my hairstyle. Don't copy my physique. Don't copy my pot belly. Don't copy everything I buy. Okay, because this is suitable for my risk profile at the age of 48 with ample assets that I don't care if this goes bust, but mine is an upside. I'm okay with it. Then don't come back to me a week from now and say, oh yeah, it hurts. It's suitable for me, not you. Viacom, 190% to the upside is what the analysts are telling you. If you remember, it was also in strategy 1. Why was it in strategy 1? Because it's what the gurus had also bought. So the more strategy it fits into, the more likely I am to be right. Now, for all of these, what the analysts is, it's a 12-month holding period. In that time frame, I'll either, at the end of that, it'll hit my price target, or the time will have run out, and I'll then reevaluate to see, do I keep holding because it is in one of the other strategies, or do I sell because it's not hit my target and it's not in one of the other strategies? Good. Get out of there. Okay, United Healthcare, remember, one of the most popular, safer one to hold for 12 months, but because it's safer, only 33% to the upside. Okay, investment strategy 4B. What do the banks tell their clients? Let me tell you one of the most important things they're telling their clients. Altman scores. This is what the big banks are telling their clients to look at. They're obviously not just telling the clients, look at Altman scores and here's a bloody formula. They're actually telling which stocks. Then that's what the super rich get, the billionaires get the access to. So I want to share some of that with you. What's an Altman score? Devised in 1969 by a university professor. It basically looks at the working capital that a company has and the money it's kept in its banks. All right. Basically, don't worry about this bloody formula. It's for me to know, not for you. What you need to know is if an Altman scores above 3, that means the company's very, very, very safe. So Microsoft above 3. Okay, if it's below that, you're taking more risk, but you might be willing to in order to get more returns. I'll give you some Altman scores in a second. They're also telling, this is from Goldman Sachs. This is actually a slide from Goldman Sachs Asset Management. I had lunch with Jim O'Neill when he was chairman of Goldman Sachs Asset Management. And if you're interested, he's got a copy of my book on his bookshelf because I gave it to him and he knew that's why I wanted him to put it on his bookshelf. So people will think, oh my God, the chairman of Goldman Sachs Asset Management reads Alpesh's book. He's a clever bloke. He did me a favor. My point is this: Croaky scores above 10% means a good, safe company. Who uses this to tell their wealthiest clients what to buy? Deutsche Bank invented it. Goldman Sachs use it. So does Deutsche Bank. Okay. Post-tax cash flow. Guess what's really important at the moment? Cash flow. Don't have to take my word for it. You ask your employer what's important right now. Bloody cash flow is. Okay. Simple as that. And the ability to make cash from the working capital a company has. What this Croaky score does, and if it's above 10%, it means it's a bloody healthy company. So let's look at some of them. Here are the names. I'm not going to go through every single one. Okay, there's your Altman scores. There's your Croakys. There's your Alpesh Patel value growth rating, which is better than everything. I want a 7, 8, or 9 on my value growth rating. I want an Altman above 3, ideally, and I want a Croaky above 10. If I relax any of those requirements, then I'm taking more risk in return for more return. Take a picture of this, look at it in your own time, okay? Or put another way, these are my value growth ratings above 8. Any of these I'm happy to hold for 12 months on the expectation that I should get at least a 20% return in 12 months. And these tend to be the more, as you can see, Adobe, bigger companies, bit safer. So my algorithms go through all of this. I'm giving you this. Don't say, Alpesh, where do I get this data? It's here in front of your nose, okay? It's here in front of your nose. Where is that data? You can look at it, take a photo of this. All right. Similarly, I bought Hive. This is at the other end. Why? Well, it's dropped 78%. So I'm going to make an 8-fold return on my money if, well, it's got a high value growth rating. That's interesting. And then I analyzed it and I thought, well, okay, price target 400%. Say the analyst, no, forget that. Let's just say I double my money. All right. In 12 months. I'm happy with that. Not only that, when it has down years, let's look down here. When it has down years, they're not that much down, and up years tend to be not that bad. I mean, there was one year, 2018, though, but I think it could go give me double my money in a year. That's suitable to me. Might not be suitable to you, okay? But what I'm saying is I need some reassurance. What are my reassurances on this? Well, Croaky is 5%. It's not 10, not good. But the Alpesh value growth rating is 7. So where would I put this? Medium to high risk? To at least double my money in a year, medium to high risk. And if it doubles my money, then I've got to decide, is it still in my strategy or one of my other strategies? Okay. Oh, by the way, take a picture of these if you so wish. These are the biggest fallers. If they return to where they were, you can work out. If they're down 50%, the percent of where they were, you double your money. But I ideally want a 7 on my rating. Okay. National Express came about through that. National Express, as a result, came about in that for me, and I own National Express. Okay, why? Well, Croaky near 10. Most years it tends to rise anyway. Target price, I should double my money. Medium risk for me. But there's another reason. I also look at their fair value. How do I work this out? This is called discount cash flow. It is one of the most important sources of information. Okay, discount cash flow. It is what Warren Buffett looks at. He doesn't look at price earnings ratios. He looks at discount cash flow. Discount cash flow basically says that any asset is only worth all its future incomes. So nothing is worth owning unless you can work out how much money it's going to give you. Obviously, that's just obvious. So it's all its future projected dividends, allowing for risk of those coming and not coming. Okay, and future asset price growth. And it says, well, if I can get 110 next year, what's it worth today? If I said to you, here's a contract which will give you 110 next year, how much you want to pay me for that contract? You might say, well, I'll pay you 109 today for it. And I'll say, okay, I'll take that. And I go away and I get my 109. And in a year, you get your 110. So you've made one. But you've made a profit at least. Well, you might say, I'll give you 100 for it. Whichever, we'll come to a price. That's discount cash flow. And what this is 48% undervalued. In other words, I double my money, which is what that says. I double my money if it gets there. So National Express, I own for that reason. Lloyds Bank, I don't own. I don't own because it's only 25% undervalued, and I don't like that. And also, most years it bloody gets a great, wonderful loss for me. So why the hell would I want to own it? And the reason I looked at it is somebody asked me, what do you think of Lloyd's? Why? Because people buy on name recognition. By the way, in case you've forgotten which strategy we're on 4B. What do big banks tell their clients? This is what they tell their clients. Look at these criteria, such as discount cash flow. And how do I know they tell them that? Because the target price, the analysts have said, is 100% up. Guess what? Almost exactly what the discount cash flow is. The discount. So what has the analyst done? He's gone and looked at the discount cash flow and then said my target price is 100% up. Obviously, right? But wait a minute. You don't know how many stocks to own. This is how many you own, because I've given you a lot of names. Now, I can't expect you to buy every single one of those. Okay, I'll answer all the questions later in the Q&A, but do feel free. Okay, Michael, Rob, John, everyone else. Now, so brilliant question, John. John said, do you split your portfolio into 7 strategies? You've timed this to perfection, because I'm about to answer that. Why do I only own, well, let me put this another way. Anybody else should only own 15 stocks. Why? Because if you own 100 stocks, what are you going to do? Divide your money into 1% lots, and let's say you pick a great stock which doubles in value. Well, that sounded 1%. No, you'll have bought too many. Your quality has gone, right? Equally, you don't want to have just one stock and put all your money in it. Otherwise, I'd put all my money in Amazon. If somebody puts a gun to my hand and said, what should you put all your money into? I'd say Amazon. But I don't want to just do that because it's too risky just to put it into one. Okay. By the way, the world's richest man, guess what all his money's in? Amazon. He's only really got all his money in Amazon. So good enough for the world's richest man. Yeah, but let's say we want to spread it into 15 because as you increase, anyway, risk diversification, that's what it means. Now, how do you divide up your stocks? This is what you do. All right. If you want aggressive growth, most of them will be in probably American stocks, a bit in British stocks, and then for bonds, read cash. For bonds and short-term investments, just read cash. If you want to be really conservative, right, this is how you split it up. I'm not going to suggest you do this, but this is generally the rule. Now, for me, because I'm ultra aggressive, everything's in American stocks. Well, okay, no, come on, be fair. I've got some cash as well, but roughly along those. Why don't aggressive returns? Well, because in my best year, I would expect that. By the way, this is not my data. This is from Fidelity. This is what those portfolios generally tend to return you, according to Fidelity, in terms of over the last 100 years. Okay, in my best years, I'll get 136% return. I've never had a minus 60, by the way, because I'm not that rubbish. But yeah, in my best year. Why? Because I'm only trying to target 20% per annum. Why? Because it turns every 10K I've got over 10 years into $1 million. So every 10,000 I have, every 10 years becomes $1 million based on the maths I just showed you at the start of it. Sorry, every 100 becomes $1 million every 10 years. Okay, every 100K becomes $1 million every 10 years. Equally, every 10K you have becomes 100K every 10 years based on 20% per annum. So I don't even need aggressive growth to do that. Guess what? I have more than aggressive growth. But anyway, so that's just to give you an idea of how these things work. You don't need to worry about that. These are just very simplified portfolios, but that's how you divide it up. Investment strategy. Okay, investment strategy, cash flow is king. This is number 5. That's, again, cash flow is just talking about valuations. Okay, Alam asks, is it undervalued? I look at the discount cash flow. That's all that is saying. Another one, National Express, I already told you. Baidu, which is the big American, the big Chinese, it's the equivalent, Baidu is the equivalent of Google. Okay, big search engine company out of China, listed in America. So I buy it just like an American stock, and it's 40% undervalued. So I should hopefully double my money. I'm putting this higher risk. Why? Because it's Chinese. I don't trust the data, but still it's listed in America, so I should trust it more. I reckon 100% return, but I'm willing to wait a year to 2 years in that one. So can you see how now I've got 15 names coming up all of a sudden. Investment strategy number 6, higher risk. But I'll show you how to get this data and stuff as well later on. So don't worry, give me another 15 minutes and we'll do that, and we'll do the Q&A. Number 6. Now, this is too difficult to read. I'll tell you what that says. And I own French Connection as well. Why? This is higher risk. Okay. What this is saying is what rose last year, so that's a momentum to it, which then of those have risen in the past 5 days as well. So it's got a bit of momentum. And on my own momentum rating, based on a multitude of factors, if I were to target the price it had at the end of last year, so when circumstances were normal, and let's say in 12 months it gets there, what kind of return would I get? Would I get 100% return? Okay, if I would, then I'll buy into it. So what I've done is I've said, if companies will return to where they've been in the last year, do I double my money? Okay, that's all. So that's the higher risk strategy. Remember, higher risk, because some people ask me this, and that I've given you a lot of data on the earlier slides of what those were. Okay. Forget that slide. I don't know why that's there. Investment number 7, final strategy, and then we'll talk about how to do this for yourself. I've given you lots of names how to do it for yourself, but can you see how to pocket and build now? Now you've got the building blocks of a portfolio. Medium risk, which is what most people are. Exchange traded funds. What are exchange traded funds? They're baskets of stocks, so they're medium risk. What are they? Well, in the last month, these were the world's best performing exchange traded funds. Now, let me tell you some of the things that I'm going to buy tomorrow. Okay. Where's it gone? The semiconductor index. It was here a moment ago. Sugar. It's one of these, and I've forgotten the bloody link. I think it's SOXL. Semiconductors. All it is a basket of these. So where do you find these? Well, these are exchange traded funds. They're American listed, but you've got the UK equivalent as well. They'll have different ticker symbols if you're in the UK or if you're in Denmark. So just speak to your broker, whoever that broker is, online broker. Just search online and say ETF semiconductor. Okay, we'll talk brokers in the broker section in a second. Oh, hi Tazeen. Oh, I'm sorry. It's the webinar, which is why people can't hear me all the time. I do apologize about that, my friend. Now, of these, I will want, and it's the safest thing to tell people, some people, I'm not one of them, like gold. I'm not one of them, but if you did, those are the exchange traded funds which track gold and gold-based companies. Okay. For me, what do I like? Well, as you know, I quite like the US. I'm bloody obsessed with it. And you might say, well, wait a minute, you're buying semiconductor companies and you bought cash rate technology companies. Aren't you a bit overexposed? Well, I'm happy with that. But you can pick and choose what you'd like. But I want you to know these exchange traded funds are available and these are the kind of returns they do. And because they're a basket of stocks, they're medium risk. And as I said, I'd have a 12-month target and then reevaluate if they fall into that category. Okay, leverage, that's higher risk. Then leverage is not medium risk, it's higher risk. So here TQQQ is triple the Nasdaq. So if the Nasdaq goes up $1, this goes up $3. That's high risk. That's high risk. Okay, just so you know. Now, oh, here it is. Sorry, there it is. That's the one I'm buying tomorrow morning, just so you know. Medium risk, VGT, Information Technology Exchange Traded Fund, produced by Vanguard. Doesn't matter who it's produced by. Information Technology Exchange Traded Fund. Now, different companies have different versions of this fund. They're basically invest in a basket of information technology stocks. Okay. Now, this is my medium risk one. And why do I have it? Well, because you know what? It doesn't take a genius, but I think the future's in technology. Now, how much do I expect to make on this? Well, maybe just 30% in a year. Are you happy with that? Well, I am. Now, ones I already own, because I don't want to just tell you ones I'm going to buy, but ones I already own. Amazon, 2 times leverage. There's the ticker symbol. I used Hargreaves Lansdown to buy it. It's UK listed exchange traded fund. So it's a fund which tracks just Amazon. It's actually an exchange traded product, it's called. So every time Amazon goes up $1, I make 2. So I've made 40% in the last month alone, but I'm going to hold it for longer term. I'm not a gambler. I'm not here to trade Amazon for a month and then get out and then go, oh no, Alpesh, I sold it too early. What should I do now? Don't talk to me. Okay. If you're going to try and trade it, don't talk to me. I'm here to invest. So Amazon, Brent crude, not WTI, not West Texas into whatever, because it's stored in Oklahoma, which means it's got a lot of shipping costs, which means nobody wants to own WTI oil. Brent crude is held in tankers off the coast of Britain, so it doesn't crash. Anyway, that's for me 2 times leverage. So if oil goes up to 60 from the current 20 in the next 3 years, then it's tripled. I've got 2 times, so I make a 6-fold return in my money, and I'm willing to wait 3 years. Do you see how risk and time are interconnected, my friends? Okay, Apple, that I own that. T Rowe Price, ignore that for a second. And the FTSE 2 times leveraged. And the normal second size, I wouldn't. That is not forever. That is just for 12 months leveraged. Okay, how do I do it? I scan fast US, UK, and global ETFs. I monitor infrequently because I've got a strategy and the timelines. I use one computer screen to do it. I don't just use one strategy. It's any one of those 7, preferably it's in more than one. So a guru, and so strategy 1 and strategy 4. If it's in more than one, even better. 20 investments maximum, okay? 15 to 20 maximum. I actually have more. The reason I have more is this. I'm mentoring people. Because I'm mentoring them throughout the year, I will acquire things at different periods just so I can hold them alongside them. That's why. But that's just a perverse scenario because I'm mentoring people as well. Diversify, make sure they're not correlated. So BP and Shell are the same trade, okay? Don't buy both of them or house builders and say, oh, I've got 10 different stocks. Oh, they're all in the bloody same sector. Stop loss, if they're performance stocks, example, 25%. In this volatility, maybe 50% and halve your position size because volatility-based stop losses are important. I can talk more about that in the Q&A. Quality stocks, I'd just buy more if they fall, as I've said. Add to quality, hold 9 to 18 months. This is not 9 to... Don't do it in working hours. Never buy a stock when the markets are open. The simple reason is you'll be chasing it. You know, oh, it's down now, it's up now. No. Do it calmly outside market hours. Okay? Just put an order into the broker. Do your analysis over the weekend. 1 hour max to find 10 investments to shortlist. Don't spend all your life doing it, okay? It's as simple as that. I use these strategies and more when I was at university. I perfected them. I left being a barrister because it was all working so well. Won competitions in the Financial Times, who then asked me to write books. And I said, yeah, I want a higher profile. I want to write books and get a higher profile so I can create my own fund. Because I was born in Armley and I didn't like the idea that there was a group of people who were making money by just investing in stocks. I wanted to be one of those. Who the hell wanted to work hard for a living? I saw my parents doing that, so I didn't want to do that. Sorry if that people don't like that, but yeah, I didn't want to work hard for a living. Won competitions, and I had a bloody big motivation to do so. Like I said, became an investment manager. So I asked people, look, I've given you a load of information. Are these webinars enough? And gradually what happened is, because we have a hedge fund, gradually what people say is, why didn't you spin out this from the fund? And we did this in trade, but we're now doing it in investing. And people say, well, educators, don't charge us any subscriptions. Educators, give us one-to-one attention for the rest of our lives. Lifetime educators. So I asked them, I laughed. I said, are you kidding me? I ain't got time for that. They said, well, we like you because you're a regulated fund manager. We don't want to be traveling to hotels, and you're not connected to a broker, so you actually know what the hell you're doing. You're not trying to sell a fund and say, oh, just buy my fund, or try and churn, which is what brokers do. Never listen to brokers. They want you to churn and fail. And if they were any good, they wouldn't be working at a brokerage. They'd have their own hedge fund. Okay, it's as simple as that. They'd be the elite. Okay, they said we want access to Goldman Sachs information, which only the big institutions get. We want ongoing support for life, lifetime updates, and we want to use the same software you're doing. So I said, well, wait a minute. I don't want you paying for any software. So I said, look, I'll find the best free sources of software, get my hands on, make sure it's free. Wherever it's not, like Bloomberg terminals, I'll give you the data as I get it. So you've got access to the data as well and what should be used, right? And daily updates, alerts, tips on my phone. You know, you shouldn't be looking at investments every day, but you might join today or tomorrow. So I'll give you all of that and make sure that the software that I give you access to, we actually use 4 or 5 different sources. Actually, we use lots, but we always give people the non-subscription one so they don't have to pay, and any subscriptions that are, we pay those subscriptions and give you the data so you've got access to it. And they said we want, they like this fact, and they like that it was a professionally trained communicator as well as a barrister. I was trained at Bloomberg TV as well, and if you can still hear me, Tazeen, she's on as well. She was one of our co-presenters with me. Bloomberg, Financial Times, people with credentials. The problem at the moment with the markets is there's nobody with bloody credentials. Even the brokerages have people who've got no credentials. They haven't got a bloody clue what they're doing. When I won the Financial Times competition, I was beating people who are supposed to be, you know, hundreds of years more experienced. I'm a visiting fellow at Oxford University where I lecture on behavioral finance, basically the psychology of investing. And as you saw, won awards, including the Financial Times and other sources. And we realize we've got no competition in this. We have absolutely zero competition in this. There is nobody else out there. Because when you're beating people like billion-dollar fund managers like Neil Woodford, and you're educating others to manage 10 billion like Naomi Newton, who's one of my apprentices, then you know you're onto something. And I make it clear that what I tell you is what I put my neck on the block for the last 20 odd years in front of 300 million people when I do the newspaper review as well. So we asked people, what do you think? And we collected some reviews of what people thought of my work. And I'm talking big names. I'm not talking about Mrs. Jones from, so stay with me. I'm going to show you how you access all of this. Bernard Opity, Centaurus Capital, billion-dollar hedge fund. This is magnificent. Mark Slater, Merrill Lynch, HSBC, Ivan Shuka, American Express Share People, Alpesh Patel Authority Commentator, blah, blah, blah. And we thought, you know what? We've got something here. We've got the makings of $1 billion business. We should make this global. Okay. And so that's what we did. We launched this in terms of giving access to me, one-to-one, giving access to the various softwares, make sure there's no subscriptions, no daily charges, none of that fees, but always giving you daily updates. Peter Temple from the FT, one of the savviest traders around, read, that was about my book. This is what Coot said, an essential companion for the online trader. Tom from CBS MarketWatch. We said, well, how are we going to give people connection with me, make it efficient? Well, we'll have to limit the number of people, but we'll give them WhatsApp. So I'm going to show you how 10 of you can get access tonight. Telegram, so you get my stuff, and create a community. Okay, have Zoom calls with me, Skype calls, WhatsApp connection with me, so you got instant messenger and Telegram. We created a program. We're going to take this global through the hedge fund. We're going to take this global. What I do on my webinars, well, this is the third time ever. I think it's the third time ever I'm doing this. I take on groups of 10 only. There's no subscription, so don't worry. 50% off. Only on the webinars, okay? Only on the webinars. All right, for 10 at a time who want to come on. We'll do the Q&A in a second. All right, and it's 10 at a time on the webinars with 50% off. We thought, well, how do we price 50% of what? How do we price this? So we looked through and I thought, well, what are lifetime updates are worth on what the information I've given? Maybe £10,000. What's added value to the portfolio over 10 years? We'll do the Q&A in a second as well, and I'll go through all your questions. £50,000? I can add that to your portfolio over the next 10 years, 20 years, hopefully, with the information I'm giving. Access to Goldman Sachs research and reports, so you can see all of that. £5,000. Data from premium subscription services at no charge. So I'm getting the data. I'm giving it to you when it's important, what's important. Cut and pasting that. Daily updates, tips. We've got a daily newsletter now, as well as on Telegram. I'll probably do about 10 updates on Telegram. £10,000 maybe. Always free software sourced for you wherever we get the data from free. It's our job. We've got a fellow hedge fund manager who's launched some great software which we're now using, and we've made that available free for you within the program as well. I don't know, what's that? £2,000 monthly tips newsletter, 1,000 lifetime access to me one-to-one, £5,000 WhatsApp phone access, a couple of grand. So we totaled it up to £90,000. We thought, okay, we thought, shit, what do we do with that? Can't offer that for £90,000. So in the end, we've been increasing the price ever since because the demand has been phenomenal. Our ambition is eventually to get this to probably 20,000. But anyway, it's 9,999, but it's not. On the webinar special for the first 10, use this code May50 is 5,000. We're going to make this global. We're going to send this around the world because we think we've got no competition with them. There's massive demand for this, and we've seen it so far. And because there is, each week we've had to raise the price. We started at 1,000, and we've realized from the feedback we're getting, which is phenomenal, the returns people are making, which is phenomenal, given that they've got lifetime access, they know they're going to make it back. It's that, and that's where you go. We've got two sites, because last time I did this, it broke the internet. It crashed the site. So we've got a backup site and a formal site. Shares 1, Shares 2 is where you go and use the code May50. If you go to Shares 1, you don't even need to enter the code. It's there, and you've got 7 days money back guarantee as well. So for 7 days, you can learn everything and see what we do, and you can see how brilliant we are. We have had such amazing feedback. It is phenomenal, the feedback we've had. So that's why, as I say, the prices keep going up, because for that obvious reason. If you happen to go to alpeshpatel.com/shares, then you click there, you add coupon. Once you go to the checkout page and you put the coupon code May50 and you save £5,000. It is 50% off on this webinar only. And those who've been on previous webinars know when I say the price keeps going up, you know it's gone from 1,000 to 2 to 3 now to 10, and it's going to go up to 20. Just because of the demand and what people, I mean, I've got people with £2 million portfolios, got people with £10,000 portfolios, got people with £5,000 portfolios who are saying, well, I'll buy it now because I want the price fixed and I've got lifetime access. If you go to this website, alpeshpatel.com/shares1, the discount's already in there, as you can see here, okay? The discount's already there, as you can see there. That's where you go for either of it, and join me on this, and we give you access to the software, lifetime mentoring from me, and all the other stuff as well. As you sign up, let me know so I can give you a shout out, please. okay, as you sign up, let me know. All right. And this is part of what we do. We create a business plan for you one-to-one. You can practice and test. You learn as well through the course material. And I show you the course material. The course material is updated every single day. All right. So I want you to know it's updated every single day. And I'm going to show you this now. And not only that, you've got cheat sheets, alerts, tips, software, mentoring, not just one piece of software, lots of different types, and online tools and direct access to me. And it is, again, as you'll know, the price keeps going up. And the reason for that, I'm sorry, I know the price keeps going up. The reason for that, my friends, and those of you who haven't signed up before, is because, and it's only for the first 10, I'm afraid, because I do the personal mentoring and take you on board. It's a small exclusive club, so that's why. The reason the price keeps going up is because of the value we're providing. We didn't realize how much people were going to value this. As you go through the course material, updated every single day as well, you're going to see what we see. You're going to see what we invest in. You're going to look at an X-ray into my investment portfolio as well. Okay, it is that good, and you get the updates and the information. And I have to say, Claire is completely different to the trading. It is not Pips Predator. That's completely different. Trading is holding things for 1 to 2 days. Claire, the discount you get is 50% off today on the webinar. Okay, we have 2 products. Investing, which is the Great Investment Program. This is called the Great Investments Program. And you see all our favorite strategies in action. As we do them, you get to see also my newsletters, the strategies for investing, all the updates from what the banks are telling their clients, what the hedge funds are, UBS, what the hedge funds and their best ideas are, global economic outlook, the IMF reports, and I interpret those to make it simple for you. This is not hands-off. This is you contacting me personally. This is us showing you how to do it, how to learn to be an investor. It is educational, it is informative, and that's the point of it. You also get signed copies of my book as well to keep just for trialing it for 7 days. 7-day money-back guarantee. You get copies of my book as well. Thank you, those who've signed on. I can see. Let me know. Okay, I love it. Rakesh said, can you copy your brain into a chip and give me a copy? I give you a USB as well. This is the chip, Rakesh. This is my brain in there. How to pick winning shares online using company info. Anyway, we go through all of this. I show you all this. It's all in bite size. So you become, basically, I trained up Naomi. She manages $10 billion. We put that program of what I used to train her into all of this. That's why we're going to make it global, because we think there's a whole bunch of people out there who want to, some just want to know how to be their own fund managers. Others want to be actual fund managers. And by the way, the best thing you can do if you've not done it already is join me on LinkedIn. Join me on LinkedIn. Okay. If you've got any problems logging in, by the way, no, John, you're talking about Pips Predator. This is Great Investments Program. Okay. This is investing. John, you're talking about trading. Trading and the Pips Predator program is different. Pips Predator is trading. This is investing. Investing is holding things for 9 to 12 months. Trading is trading things 1 to 3 weeks. Okay. 1 to 3 days. This is investing for the long term. All right. So we give books. Actually, the books alone I add to each week, and they're going to be probably about $1,000 worth of books in there, let alone anything else. Any of you can't get on, 1 or 2 having problems, and we bloody broke the internet last time as well, because when there's too many people, the internet thinks it's a denial of service attack. So if you go to alpeshpatel.com/shares1, you will see the discount is on the screen. You can see it there. It's already in there. And if you go to alpeshpatel.com/shares, then it's then it'll take you to this page and you enroll there. So you get access to what I'm buying personally, what's in my hedge fund. You get the real, what's in my personal ownership, and also what my hedge fund is investing in as well. Not trading, investing in. Okay. And you also get to meet me and all those things and have direct access to me. You can see the endorsements I've had about what I do from Barclays. Alpesh clearly brings to life just between what analysts and the media spin and what you should trust. That's Barclays. Rothschilds, Mr. Patel spoke at their event, tailor-made presentation, global market. So I speak for Rothschilds. They pay me to reach their audience. Okay, so these are some of the benefits. All of you who come on, let me know. Yes, John, it's 50% off on this webinar for Pips Predators users. For Pips Predators users on this webinar, it's 50% off. Okay, that's what it is. So you go there and that's the discount. Now I can't say fairer than that, because 50% is a whopping great amount. For everybody else, okay, and this is just for the webinar. All right. So after this, all right. And that's because it's fair. You guys have been on to the end of the webinar. Why should it not be a bit deeper discount for you guys? Analysis for each stock, ratings, all of this within there, and full access for life. Basically, we want to get you to be your own fund manager. As I've said on the BBC, that's what I want people to do. That's been a lifetime mission. And that was a lifetime mission, right? Because this is what we found with competitors. They're just rubbish. They're naff. They're just no good. They don't have any credibility. Okay, and there we go. All right, so it's on there. You click on join now, and you put the coupon code 50% off May 50. Okay, you click there. You put in May 50 and that coupon code, you apply, and you get £5,000 off. All right, it's as simple as that. Why is it expensive? Because let's face it, it is expensive. The reason it is expensive, very, very simple. Those are the two websites. Sorry, a lot of people are asking, where's the website gone? If you can't log on, let me know, and I will send you a PayPal link if there's a problem with logging on. I do apologize. I know when there's a lot of people getting on, that's what actually happens. Okay, so let me know. Alex, you haven't put the coupon code in. When you click on join now, if it says 999, that's because you haven't put the coupon code in. Please put the coupon code in, May 50, or I will send you a link now, Alex, on PayPal as well, and that will get you in, my friend, with the coupon code. So if you've gone to, let me know which URL you went to. If you went to shares, you need to put the coupon code where it says, look at this screen, where it says add coupon, click on it and put May 50. If you went to shares 1, coupon code's already in there. All right, I am going to, my friend, in any event, also send you on PayPal a link. All right, so use this before they're all gone. I'll send you the link now as well on that, and I'll make sure it's held for you, because whenever we get IT problems and people, I do keep my word, and I'll make sure you'll get it at this price. Okay, so even if we raise prices to 20,000 tomorrow, whatever, or remove the discount, you will always have this. So don't worry. I know, because I'm not going to let IT problems be a reason not to be able to access this. Okay, so I've done that there. Okay, you should have that, Alex. It's been sent to you, and also I'm sharing the link now. Please try and use this today though, because it won't work from tomorrow for obvious reasons. So I'm going to reply to you in private. Anybody else got problems? Let me know of signing up. Alex, use this link, please, and please use it today. Okay, there it is. That's where you go, and that's the webinar special. Now, I originally was going to apologize that it's expensive, but I can't apologize it's expensive, because when you're making people tens of thousands of pounds, then it's unfair that and you're giving them lifetime access with no subscription costs and software and education and daily updates. It's unfair that something should be any lower, and that was the thing. In an ideal world, we charge like we do with the hedge fund, 20% of performance, but that's not what can happen. Okay, so just so you know, that's where we are with that. Apprentices, students, I don't know, what should I call you? I'll come to you in a second. Now, let's answer some questions as well. Any questions at all? Ask me any questions about anything. You posted some questions earlier. Let's go through them. Let's go through them on this. Thank you all who've come on board. Welcome, welcome, welcome. I'm not sure. Try and go on. I'm not sure. Narendra, it used to be a long time ago. You might be right, Narendra, actually. You might be right. You might be right. You might be right, Narendra. I think you're right. No, Narendra, you're right. Apple, Amazon products, yeah, are they available to buy in regular broker? Yeah, regular broker like Barclays. You call them up, you say I want double leveraged, or Hargreaves Lansdown or AJ Bell. Yes, Sylvain has asked. 2 brands. Yes, one's for trading, and the one today is for investing. Both, no, they're totally different, Sylvain. Trading is what you do and hold things for 1 to 2 days, and you're trading forex. This is investing in shares for 9 to 12 months. So different time frame. Brokers, Hargreaves Lansdown, AJ Bell, Barclays Stockbrokers, Halifax, all good. Jap, not sure whether I got for that, but I bought those. Okay, Jap, I'll double check. If you haven't got the full discount, I'll make sure that you get the discount refunded. So don't worry, the discount should be there. Don't worry, Jap. Let me know which link you use, Jap, for that. Narendra, you're absolutely right. Let me know which link you use, Jap, for that, okay? Just so I know. Anybody having problems on signing up, let me know. So just to make clear, Sylvain, got two programs. One is trading, which is pipspredator. That's for trading foreign exchange, holding things for 1 to 2 to 3 days. That's it. This is investing in shares and exchange traded funds, holding them for 9 to 12 to 24 months. Not trading, investing for long term. Got it? Thank you very much, Raj. I really appreciate it. Shares one. Oh, the discount. If sometimes it doesn't show up because of the cookie, if you go to the bottom of the screen on there, you're able to enter May 50 and it'll appear. Okay, open the account, put the account here. I'll put what to do now. Lana, oh Lana, you're already on board. Email me. We'll walk you through the steps. Email me. Is there a special discount? You're already up. Yes, Glenn. On this webinar, it is 50% off. The people on this webinar are pipspredator users. Okay, it's 50% off to you. Glenn, it's 50% off. That's what it is. Sylvain. Okay, thank you. No worries, Sylvain. No worries. Can you trade US shares in ISA account? Yes, Philip, because my son has a child ISA and he owns Amazon and Microsoft. And he's up about 75% from when he was born, which was February, 2 years ago. So anyway, he's up 75% in his childhood ISA. The boy's going to be very wealthy. Philip, and by the way, in a childhood ISA, you can only put 5,000 in a year. So I'm not talking big money. I'm talking about each year, 5K goes in. I buy him a couple of stocks. I share it with the public, what he's bought. And over the next 18 years, you're going to follow it with me. And because the law is you're going to put 5,000 into a childhood ISA and you're going to follow what he owns each year. Okay. Narendra said, now let's get insider info. The insider info. Okay, Narendra, I'm going to give you the insider info. You know, earlier I showed you what those hedge funds, the billion-dollar hedge funds own. That's the insider info. Though that is if you said to me, open the lid, take me around back, that is it. That is being missed by the rest of the market. Those stocks that I showed you earlier. Okay, that's the insider info. Oh, by the way, apprentices get Zoom calls with me, one-to-one, WhatsApp, instant message, all the rest of it, and all the backing of all the brilliant credentials that I have. What I want to do is just going to go through these scroll through these slides just in case you missed anything whilst we do that. Anybody who had difficulty signing on, let me know. I don't know if there's any programs there, but if you go through, it should be. Anybody had any problems with the discount, let me know. Japs asked, how do you double or triple your leverage? The exchange traded product has the double leveraged within it. So Microsoft, 2 times leveraged, is already embedded. The leverage is embedded within there. Okay, it's embedded within there. Does that make sense? Does that make sense? The leverage is embedded within the Microsoft exchange traded product. Okay, so that's how. But I can explain that to you. Will we get this all the time? Yes, absolutely. All you had to do was just follow me for the last month, and if you're on the program, you'd know every day this stuff gets on. I give about 10 different pieces. That's right, every day. Why? Because I do this. I do this, and I'll handhold you through that, Jap. So don't worry. Is it Jap or Yap? I'll handhold you through that. So I'm just going to go through this. That was the hedge fund stuff. And it comes on Telegram. Sometimes people don't understand, and I show them on Instagram then. It's one way or another. I explain to them, okay, how it happens. All right, on that. So let's go back. There we go. DDDD. What's the date today? It's the 6th. Okay, there we go. There we go on here. And on there, why? It's there we go on here as well. Some of the stuff that's gone through. There we go. All right, some of the stuff that I've gone through. Okay, is it possible to pay by debit card rather than credit or PayPal? Yeah, all those systems take debit cards as well. sending limit. I rarely use PayPal. If you give me the bank details. Yeah, Alex, I'll do that. I'll do that. No worries, Alex. I will send you that right now so you don't miss out. I'm holding one for you, Alex. Okay, I'm holding one for you. Okay, so I will make sure I just let my assistant know to keep one for you. All right, we want to do that. Because what I don't want to happen is that you miss out on any of this. Okay, so yeah, I'm going to send you the banking details. Yeah, because some people, they're saying it hits limits and all the rest of it. What should take a company with big debt? Oh, well, that's what we use the Altman score for. The Altman score and the Croakey will work out the debt. If it's got big debt, it's going to have a really poor Altman score, and therefore not a good purchase. Alex, I'm just replying in private to you with the sort code and the account number. Okay, sort, there we go, and the company name. There we go. And the amount is what was written on the PayPal invoice. Okay, there we go, and it's oops, and it's Lloyd's. Is in case you're asked which bank. No, Stefania, it's the Altman score. It's not just about debt. It's all the things. Themis, I'm sending you the bank details as well. Yeah, I know some of you preferred that because I know it's difficult on, it's easier to do a debit card transfer, but well, a wire transfer because it's easier. There it is. Okay, I'm sending those to you as well. Okay, account and sort, and here we go. So anybody who preferred to do bank wire transfer, the amount was there we go. Okay, it's on there. Yeah, so what you related debt to make a judgment. Look at the Altman score that I mentioned earlier, which looks at how much debt a company has. I'll just show you that in a second. Okay, what we look at on that, and you see what it does is because it takes in a whole bunch of things like cash flow, working capital, and so on. It instantly, here it is. It instantly takes all that information in and puts it into one number. So it makes my life a lot easier, but not just mine. I know it's what the big banks are telling their clients. Where's it gone? Okay, I know it's what the big banks are telling their clients. So this tells me how much debt a company has. It tells me the working capital based on their total assets and the retained earnings and the total assets over here, total sales to assets. Debt will be incorporated within total asset. I'll get an idea of their debt levels from the total net assets that they've got, and the Altman score will help me calculate that. And in a way, this is working out the same thing, but slightly different formula. Okay, as well. Stefania, I'm struggling with assessing the investment case sometimes. Yeah, I know. Well, what you do is you pick out which strategy it falls into. It's as simple as that. And what I've done for my apprentices to make things even easier for them, is that they also, on top of that, the apprentices also, on top of that, get a checklist. So because they've got a checklist, that will save them a hell of a lot of time as well. Okay. That will save them a lot of time as well. I think for some of you, it's giving you a bigger discount than you should have. I will have to get back in touch with you and reduce that discount, I'm afraid, because for some of you, it's giving you a bigger discount than somehow the system has miscalculated what the actual figure, the correct figure is. So we'll work that out anyway shortly when we do the checkout and everything else. Okay, so what you can see, what you're seeing on all of this, just want to make sure. Yeah. Okay. Any other questions? Is it okay to look at short-term companies with the worst Altman scores? Do pipspredators get 50% off? No, Claire, pipspredators users don't get 50% off the 50% because that would then be 75% off. They get 50% off today, Claire. I'm afraid. I hope that's okay. Anybody else need the company details to make wire transfers instead as well? Abdel, are you guys releasing a recording of this webinar? Yep, it'll come. You'll get an email on that. Philip has asked, is it okay to look to short companies with the worst altman? We don't do shorting on the investment side because it's an investment. So you're talking about trading. That's not what we do. You could. It's not a strategy that's in one of my 7. So I don't want to just give you a haphazard answer on that without a well thought out detail. Themis, did I give you the bank details? I can't remember if I did. If I didn't, they're here as well. Please try and do that today because for obvious reasons. Okay. As well. And I just want to make sure everything's working properly. Okay. There we go. Oops. Okay. And any other questions? What other questions have we got? Any more questions? Please. Oh, Themis, I've just sent it to you, so you should have it now. And we're holding one for you as well, Themis. Okay. Where are you located? Just so just let me know as well. Claire wants, there we go, company details. We'll keep one for you as well, Claire, because I know a few people have preferred it that way as well, and that's perfectly fine. Okay, that's perfectly fine as well. All right, so I've sent you that. Anybody else? Right. Anybody else? Anybody else? Yeah, got it. I think, Alex, I sent you reply in private. There we go. Oh, and we send invoices to everybody as well, so you'll have full-blown invoices, so there's not an issue there as well. Okay, Barnett, great. Hopefully we can meet in London. Jeff says, I can't find the discount box on the website. Jeff, can I send you the PayPal link? That will mean that it'll make life easier. You don't need PayPal to use PayPal. You can still use credit and debit cards on PayPal. But let me send that link. And that should make things easier for you. Ah, you found it. Good. You found it. That's fantastic. You found it, so that's good. Good. I know it's a little bit tricky, isn't it, the signing in process? Apologize for that, but please do, because we're holding that for you, Jeff. Please do, because we've actually technically, I think, gone over it to 11 because of the other people who haven't got on yet, I'm afraid. So please do use that straight away if you could. Please, I'd be most grateful. Okay. Use that if you could straight away, please. All right. Just making sure everything's fine and dandy. It's probably easier on alpeshpatel.com/shares, alpeshpatel.com/shares. And the reason for that is you'll get direct access straight away, but you'll also get an email from me in any event, whichever grouping you're in. One of the things that I wanted to show you again was this figure. Where's it gone? Where's it gone? Was it gone? This one. Whoops. This one. This is my plan for my son in any event, but the idea is whether it's 10K, if you're starting off with 10K, that's the idea, that we just want to make sure you learn how to do it. Oh, Jeff said the screen's frozen. Let me send you. Jeff, it will freeze if there's a lot of people trying to get on it at the same time. Let me just send you the PayPal link if I may, Jeff. Let me send that right now. It'll make things a bit easier. I apologize. This happened before. It's just that there's so many people trying to get on all at the same time because obviously a 50% discount and they've stayed to the end of the webinar. So it's obviously very popular, and that becomes an issue because of the whole shebang on that. That's the thing. So Jeff, I'll send you the link. Share link. Okay. Reply in private. Here we go. That's your private. Oops. That's your private link, which will just work for you on PayPal as well. Oh, Themis has said no email. Sorry, Themis, I think I didn't send you the email. I will send you that. I think I just sent you the company card details, not the email. Let me send you the email, Themis, as well. Boom, boom, boom. Here we go. So we've got so much demand as ever. And as you know, the prices will go up, not for you guys, you're on here, but they will be going up for others, because obviously it's a bit like selling seats on an airplane. You know, the ones at the back, they go first and the cheapest, and then the more students there are. We're going to make this a global program where there'll be other people who will be doing the mentoring and advice, but you guys will always have me for life, by the way, just so you know. You guys will always have me for life, so don't worry about that. I've emailed you the PayPal link, Themis, okay, and also bonsoir trader. I am also sending you this link as well, which you can use as well, but please use it tonight, because some people last time, they didn't get around to it till the next day and it had expired and the place had been taken up, gone. So sorry about that. Okay, Jeff, I think I just sent you the email, didn't I? As well, so you should have that. Jeff, I hope you've got that as well, and that should be there as well. So you should have that, and the PayPal link is also the next best solution in terms of all of that. Okay, so that should work well for you. Right now, any other questions? So this is the one which sort of really, you know, people just don't understand how quickly returns accelerate. And it's compounding, that's all it is. It's just because, but people don't have the proper strategy. And when they don't have the proper strategy, that's what ends up happening with them. Okay, so that's part of my job, is to get you to that target through a business plan, through a consistent methodology. And by the way, let me just show you how we do that. It's not just the softwares that we use that you get access to and free, so you don't have to pay for them ever again, but it's also through the structured approach to turn you basically into a fund manager, to make sure that you get to be effectively a de facto fund manager. Okay, here we go. I'm going to show you this now. And right, it's through, I'll just show you the bits because people have asked how do we do it. It's the mentoring, it's the software, it is the business planning, it is also for beginners. Okay, complete beginners start here, intermediate can skip. How do I decide when is the right for me? Stocks, ETFs, mutual funds, investment trust, company valuation. So that's for the beginners. And then important information, right? The software and website updates, profiting from what's worked in investing over the last 100 years. We look at 100 years worth of data, tell you what's worked. And then daily updates on what I'm buying, why I'm investing in it, what the big banks are telling. I can't buy all the stuff that comes up every single day from every single bank. Okay. Thank you, Alex. I've made a note for that. Themis, I think I answered that, didn't I? PayPal have now said, sorry, we cannot complete your payment. Oh, Jeff, it's like one of those things. Don't worry, Jeff, I'm holding it for you. I am definitely holding it for you, so don't worry about that. I've given you the bank details. If you're, so that's probably the next best option, Jeff. Okay. There we go, Jeff. I've sent you the bank details. Okay, and if you need to know, it's Lloyd's Bank as well, just in case you're asked. All right, simple as that. Okay, Themis, I will double check that. I will double check that has indeed gone through. Okay, I will double check that's gone through. Thank you very much. And Jeff, we're holding it for you. Everybody else who I said that we're holding for, don't worry, I am holding it for you. So we'll make sure that it has gone through for everybody it's supposed to have gone through for. Themis, I had a problem with card, right security message, please confirm. Themis, did you use the bank transfer? In which case I will double check with that as well. Or did you use just online? If it was bank transfer, I'll check the bank just to make sure so it's all safe and secure for you as well. Okay, so we'll make sure it's all safe and secure for you as well. Okay, on that. We'll make sure that that's happened on the banking side. Any other questions that anybody has? Any queries about how we do this, how I show people, how I educate people? Okay, Themis, I will have to double check because I can't see something at the moment. Just let me know. Just write out which name it would have gone under, because I can't see it on PayPal under Themis. Oh, actually, wait a minute. It'd be your email, isn't it? No, Themis.Themis. No, can't see it on either. No, on PayPal or on Stripe, our normal sort of payment thing. But I'll double. Yeah, no, it would come up straight away if it had. So, not seeing anything on that, I'm afraid, as things stand. But sometimes maybe it just takes a little bit of time for the system. So don't worry, I'll hold it for you. It might just take a while for the system, for your bank to send it through. Maybe it doesn't come through, but I'll keep refreshing. So don't worry, we're holding it for you because I know there's a whole bunch of people. I know Jeff, I know Themis, Alex, you've arranged with the bank, Richard, and who else is there? There's a few of you, Claire. So we're holding those for you. Sorry, there's always these IT issues. There always seems to be an IT issue. I don't know why there is always an IT issue. I just think it's because there's always a lot of people trying to get on at the same time for some reason, and that's what causes it. But anyway, it's what there is, and that's what there is. So there we go with that. Okay. For some reason, okay, gonna have to speak to a few of the people on there. That's fine. Okay, there we go. Please come. No, I've done all that. Right, make sure. Themis, the last time I made a payment, it was rejected and I ended up paying. Oh, okay, yeah, no, don't do that. Don't do that. Don't do that. Don't pay twice, whatever you do. I mean, we can refund it straight away. But I don't want you paying twice for anything. Okay, guys, I think I better go and deal with the new students, get them on board and all the rest of it. And if there's no other questions, then I'll make sure I go through all of this just to make sure, or at least my team does, just to make sure anybody who has problems signing in, that we've got you. That we won't abandon you, and that you will have the price with the 50% discount. Okay, so don't worry. We'll make sure it is with the free. Alex, yours has come through. So don't worry, I've got yours. I'll make sure you get the email to sign you in. Yes, John, the answer to your question is yes. Regular brokerages offer those exchange traded products. For instance, Hargreaves Lansdown do. You just tell them on Apple double leveraged exchange traded product, and they'll tell you the ticker symbol. I give the ticker symbol anyway, but they will also tell you as well. Okay. So don't worry about that as well. With the moment will be available for watching it. Yes, Lana, you will get an email, and Lana, email me because we want to make sure that we've got you on to speed with all the other bits. As well, because I know you're an apprentice, so that's great. And you'll get an email reply, an email which will allow you to watch this replay as well. Okay, and I'll make a note of all the emails of all the people who had difficulties getting in, and make sure that we keep it for you. Okay, so we set it aside for you. So don't worry about that at all. I'll make sure that that happens. Okay, so I want to thank everybody who's been on the webinar. Any other questions, just let me know. Anybody had any problems who didn't have a chance to get on, just let me know, and I will make sure that you're sort of protected, as it were. The price is frozen for you, and that you are indeed protected, because I don't want anybody getting upset that they missed the opportunity. I've had a couple of people in the past, they missed the opportunity. The next day, the link was void, and they couldn't get on, and it is a generational opportunity. It's once in a generation with what's happening in the markets to get on at the moment. And I've never seen markets like this except for 10 years ago. So they come on, well, maybe not once in a generation, they come on every 12 years. So the next one's due in 2032. So by then, I hope to have my son, who's 2, and a bunch of you lot well on that curve of saving and responsibly investing. Responsibility is what's key, and then doing good things with the capital. Oh, by the way, every single one of you, I should have said this, every single one of you, please do join up with me on LinkedIn, okay, which is free to join up. And there's a reason for that. There's a reason I want you to join up with me on LinkedIn. It's a good way to network and find each other. You'll also see all the work that I do. You will see I'm the proud son of an immigrant NHS nurse as well. Okay, you'll also see what I do with government around the world and this. Okay, no worry, Alex. We'll make sure that you get the email. It's come through, by the way, Alex, on the bank transfer. So I'll make sure you get sent the email, Alex. That's all come through. So there's no issues with that. Okay, so I want to thank you all very, 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 very much. And yeah, students, you're going to get the emails and the access codes in just a second. So thank you all very much indeed. Thanks everyone for being on the webinar. Okay.